Welcome back, everybody, to another deep dive with us. This time, we're taking a trip to Thailand.
Virtually, of course.
Yeah, virtually. Of course, we're not actually going there.
Not yet, at least.
We found this really interesting series of videos and all about algorithmic trading.
All in Thai.
Yeah, all in Thai. So we're going to break it down for you.
Translate it all.
And explain what's going on.
And this one is a really interesting strategy called trend following with advanced MKC template.
Okay.
So that's what we're going to be looking at today.
It's a mouthful.
It is, but it's broken down really well in these videos.
Yeah, and they use this software called AmiBroker to kind of demonstrate everything.
Yeah, which if you're not familiar with it, it's a very popular platform for
Yeah.
algorithmic trading and back testing and all that good stuff.
Okay, so before we get into the nitty-gritty of this strategy, can we take a step back and talk about this MKC thing?
Yeah, MKC stands for market class. So
yeah.
it's basically a way of categorizing,
Yeah.
exactly, putting the market into different buckets, so different states the market can be in.
So is it like uptrend, downtrend, sideways?
Yeah, exactly. So they've got things like uptrend, downtrend, high volatility, low volatility.
Okay.
And they use different technical indicators to define these.
Oh, so it's not just like eyeballing it like, oh, this looks like an uptrend.
No, they have.
There's actual math behind it.
Yeah, there's rules.
Okay.
Yeah.
So what kind of indicators are we talking about here?
So they use a lot of the classics like ADX, PDI, MDI.
Okay, hold on. Those are some serious acronyms.
I know. We'll break those down. Don't worry.
Jeez.
So ADX, that's average directional index, and that basically measures the strength of a trend.
Okay.
So the higher the ADX, the stronger the trend.
Whether it's up or down?
Exactly. It doesn't tell you direction, just how strong it is.
Got it. Okay.
And then PDI and MVI, those are the plus directional indicator and the minus directional indicator, and those tell you the direction. So if PDI is higher than MDI, you've got an uptrend and vice versa for a downtrend.
So it's like ADX is saying, hey, we're moving, and then PDI and MDI are saying, okay, this is which way we're going.
Exactly. Yeah, perfect analogy.
Okay.
And then they also use ATR, average true range.
And that one's for...
That's for volatility. So it measures how much the price is moving up and down.
Okay, so big ATR means big swings.
Exactly.
Yeah.
Volatile market.
Small ATR.
Things are pretty calm.
Okay, got it. So we've got these different market classes, and then the strategy uses these to...
Yeah, so the strategy is all about trend following. So it's going to use these market classes to identify when to enter and exit trades.
Okay, but then they take it a step further and start talking about merging these market classes.
Yeah, that's where it gets really interesting.
This is where I was like, whoa, hold on.
Yeah,
What's
so
on here?
Instead of just trading any uptrend, they're looking for specific combinations of market classes that might lead to even bigger moves.
So like an uptrend, AND, high volatility.
Exactly. Yeah, that's a classic example.
Okay, that makes sense because you want to be in a strong trend, but you also want it to be moving. You know, you want those big price swings.
Yeah, exactly. So merging those market classes is like fine-tuning your search for those really juicy opportunities.
Okay.
Yeah.
So how do they know if these merged market classes actually work? I mean, are they just guessing or...
No, they use back testing. So they test the strategy on historical data to see how it would have performed.
Ah, so like a time machine for their trading.
Yeah, exactly. See if their ideas would have actually made money.
That makes a lot of sense.
Yeah.
Okay, so they're not just throwing darts at a board?
No, they're being very systematic about it.
Okay, so we've got these market classes, we've got the idea of merging them, we've got back testing.
Yeah, and they also talk about dynamic position sizing and stop loss levels.
Oh, yeah, this is where things get really interesting.
Yeah, so instead of just risking the same amount of money on every trade, they adjust it based on the market class.
Okay.
So if they're really confident in a setup, they might risk more, and if it's a bit more risky, they might risk less. That's smart.
And the same goes for stop loss levels.
So they're constantly adapting.
Yeah, exactly. It's all about managing risk and maximizing potential profits.
This is starting to sound like a pretty sophisticated system.
It is.
Okay, so we've covered a lot of ground just in this intro.
We have.
We've talked about market class identification. We've talked about merging those market classes. We've talked about back testing.
Dynamic position sizing and stop loss levels.
Yeah.
A lot to unpack.
We've got a lot to unpack here. So
We do.
why don't we take a quick break?
Sounds good.
And then we'll come back and we'll dive into some specific examples of how these market classes are defined and how they're used in the actual trading strategy.
I'm excited to get into the details.
Me too.
All right, so let's dive into some of those specific examples.
Yeah, let's get into the nitty-gritty of how these market classes are actually defined.
Okay, so we talked about uptrends, we talked about high volatility.
Right.
What about those downtrends?
Yeah, are they just the opposite of an uptrend?
Yeah, pretty much.
Okay. So remember how we said a strong uptrend is when the ADX is high
Right.
and the PDI is greater than the MDI?
Yeah.
Well, a downtrend is basically the same thing but flipped.
Okay.
So ADX is still high.
Meaning a strong trend.
Exactly. Yeah.
Okay.
But this time the MDI is greater than the PDI.
So it's like the ADX is saying, hey, pay attention, there's something happening here. And then the PDI and MDI are like, okay, this is the direction.
Yeah. Perfect analogy.
All right, cool.
So that's downtrends.
And what about high volatility? How do they define that specifically?
So for high volatility, they look at the ATR. Remember, average true range.
Yeah.
And they compare it to its 20-period moving average.
Okay.
So if the ATR is above that average.
We're in high volatility land.
Exactly. Yeah. Buckle up.
And then I'm assuming low volatility is just the opposite.
Yeah, you got it.
ATR below the average?
Below the 20-period moving average, things are nice and calm.
Okay, cool.
So we've got our 4 basic market classes: uptrend, downtrend, high volatility, low volatility.
Right.
And remember how we talked about merging these?
Yeah, the merging thing, I'm still kind of mind blown by that.
Yeah, it's a powerful concept.
So like what's a specific example of how they would actually merge those?
So let's go back to that example of uptrend and high volatility.
Yeah, that one was really interesting.
Yeah, so what they're doing there is they're saying, hey, I'm not just interested in any uptrend.
Right.
I want an uptrend that's also got some juice.
Some momentum.
Exactly. I want those big price swings because that's where the real money is made.
Yeah, it's like you're looking for a wave to surf, but you only want the big ones.
Exactly. You don't want to be paddling around in the little ripples.
All right, so we've got these market classes, we've got the merging.
Back testing.
Oh, yeah, right.
Back testing.
Now make sure it actually works.
So they're not just coming up with these ideas and then like throwing them at the market and seeing what sticks.
No, they're testing them rigorously on historical data. So if they say, okay, we think this uptrend and high volatility combination is a winner, they're actually going back and looking at how that would have performed in the past.
Exactly. Yeah. And that's how they determine whether it's a viable strategy or not.
That's awesome.
It is. Yeah, it takes the guesswork out of it.
Okay, so let's get back to the actual trading strategy.
Okay.
We've got these market classes, we're merging them.
Right.
How does the strategy actually use this information to enter and exit trades?
So at its core, the strategy is a trend following system.
Oh.
So it's going to buy when it identifies an uptrend MKC and sell when it sees a downtrend MKC.
So it's riding those waves.
Exactly. Yeah, buying low, selling high.
But then they also have those dynamic position sizing and stop loss levels, right?
Yeah, that's another layer of sophistication.
So it's not just about entering and exiting based on those market class signals.
No, they're also adjusting their risk and potential reward based on those market classes.
Give me an example.
Okay, so let's say the system enters a trade based on an uptrend MKC, but then it sees that volatility is increasing.
Okay.
So what it might do is adjust the stop loss level.
To give the trade more room to breathe?
Exactly.
Right.
Yeah, because with higher volatility, you expect bigger price swings.
So you don't want to get stopped out prematurely?
Exactly.
Yeah.
You want to give the trade a chance to work.
That makes sense.
And then on the flip side, if volatility is really low, they might tighten the stop loss
Okay.
because they don't expect the price to move as much.
So it's all about adapting to the current market conditions.
Exactly. Yeah, it's a dynamic system.
And what about that position sizing thing?
So with position sizing, they're adjusting how much money they're risking on each trade based on the market class.
Okay.
So let's say they identify an uptrend A&D high volatility.
Like that combo we were talking about.
Yeah, exactly.
That magic combo.
Yeah. So in that case, they might increase their position size.
Because they're feeling more confident.
Exactly. They see more potential for profit in that setup.
And then I'm assuming if it was an uptrend but low volatility.
They might reduce the position size
Okay.
because it's not as strong a signal.
So it's like they're saying, okay, we still like this setup, but we're not going to go all in.
Exactly. Yeah, it's all about balancing risk and reward.
This is so cool.
It is. Yeah, it's a really clever approach.
So the system is not just identifying trading opportunities, but it's also adjusting how much it risks and how it manages those trades based on these market classes.
Exactly. Yeah, it's making intelligent decisions.
I'm starting to see how this all fits together.
Yeah, it's a lot to take in, but it's all very logical when you break it down.
Yeah, it is.
And the videos do a great job of explaining it step by step.
Yeah, they really do.
So even if you're not a programmer, you can still follow along.
I think that's really important because sometimes algorithmic trading can seem so intimidating.
Yeah, it can be.
But this really breaks it down and makes it accessible.
Exactly.
Yeah.
Yeah, and even if you don't end up building your own algorithm,
Right.
you can still apply these concepts to your own trading
Yeah, like even if you're trading manually, you can still look for those trends. You can still assess volatility.
Exactly. Yeah. And adjust your position sizing and stop loss levels accordingly.
That's awesome.
It's all about being aware of the market conditions and adapting your approach.
Okay, so we've covered a lot of ground again in this section.
I have.
We talk about how they define those specific market classes. We talked about how they merge them. We talked about how the strategy actually uses those signals to enter and exit trades.
And how they incorporate dynamic position sizing and stop loss levels.
Yeah, all really important stuff.
It is, yeah. It's the heart of the strategy.
So I think we're ready to move on to the final part of our deep dive,
Okay.
where we'll summarize everything and leave our listener with some food for thought.
Sounds good.
Okay, so we've explored this really fascinating Thai trading strategy, and
Trend following with advanced MKC template.
yeah, what a mouthful.
It is, but it's a really cool concept.
So as we wrap up this deep dive, what are some of the key takeaways that you think our listeners should remember?
Well, I think the biggest one is this idea of market class analysis.
Yeah.
It's like giving your brain a new set of glasses for looking at the market.
Instead of just seeing random price movements, you're actually seeing trends, you're seeing volatility.
Exactly. And you're categorizing those different market conditions.
And then you're using that information to make more informed trading decisions.
Exactly. Whether you're building an algorithm or trading manually,
Right.
this concept can be incredibly valuable.
Yeah, and I love that idea of merging those market classes.
Yeah, that's where things get really interesting.
It's like you're not just looking for any old trend, you're looking for a trend with some extra oomph.
Exactly. You're looking for those specific combinations that might lead to those explosive moves.
Yeah, like an uptrend with high volatility.
Exactly. That's the classic example.
All right, so we've got market class analysis, we've got merging those classes.
And then, of course, backtesting.
Oh yeah, backtesting, can't forget about that.
Absolutely critical.
Because you got to make sure your ideas actually hold water.
Yeah, you don't want to just be guessing.
You want to have some data to back up your decisions.
Exactly. Backtesting lets you see how your strategy would have performed in the past.
Yeah, it's like a time machine for your trading.
It is.
And then, of course, we can't forget about those dynamic elements.
Position sizing and stop loss levels.
Yeah, that's what really makes this strategy adaptable.
Exactly. It's not just a set and forget system.
It's constantly adjusting to the market conditions.
Exactly.
So whether volatility is high or low, the strategy is adapting its risk and its potential reward.
And that's key for long-term success in trading.
So this trend following with advanced MKC template strategy,
What a name.
it is quite a name.
But it's a really brilliant approach.
It is.
It combines trend following, market analysis, dynamic risk management.
And it shows how a computer can actually make intelligent trading decisions.
Exactly. It's not just about blindly following rules.
It's about understanding the market and adapting to its ever-changing nature.
And that's a lesson that every trader can learn from,
Absolutely.
whether you're using algorithms or not.
So for our listeners out there, I hope this deep dive has sparked some new ideas.
I hope it's given you some things to think about.
And maybe even inspired you to explore some new approaches in your own trading.
The world of trading is vast, and there's always something new to learn.
That's right.
So keep an open mind, keep exploring, and keep pushing yourself to improve.
And on that note, I think we're going to wrap up this episode.
Sounds good.
Thanks for joining us for another deep dive.
Always a pleasure.
And we'll see you next time.
Happy trading, everyone.